Hello, I'm Sean Rickerby of Rickerby Wealth Group of TD Waterhouse. In this, our second segment about bonds, we will look at the various terms used when discussing bonds and how bonds are valued. Although governments and companies have been raising money by issuing bonds for hundreds of years, it was not until the beginning of the Second World War that bonds became popular with the average Canadian investor. Here's a war savings certificate issued by the Government of Canada in 1940. In 1946, the government began issuing the now familiar Canada Savings Bonds. Now, bonds pay the holder a fixed interest rate. Initially, most bonds had coupons attached, which the holders detached and cashed at their local bank. You may remember Grandma clipping her coupons each November. That's why a bond's interest rate is commonly known as a coupon rate. Today, however, most bonds are registered and stored electronically. Let's examine a recent bond that was issued by Sun Life Financial as an example. With the exception of bonds issued by the government, bonds cannot be sold to the public until a legal document called a prospectus has been filed with and approved by one of Canada's provincial securities commissions. When a bond is initially sold to investors, this is known as the primary bond market. This Sun Life Financial bond will pay the holder a fixed interest rate of 4.38% annually for the life of the bond. In this case, the bond matures in 2022, and this is the maturity date. Par value is the dollar amount of the bond at the time it was issued. Most bonds are sold in multiples of $1,000, and this is commonly known as the par value. Therefore, if an investor held a $1,000 bond, he would receive $43.80 in interest every year until the bond matures. At that time, he will receive back his $1,000. However, the vast majority of bonds pay interest twice a year, and thus an investor receives $21.90, and as I say, he receives it twice a year. In this case, his yield is said to be 4.38%. However, bonds are liquid, and they're often traded prior to maturity. In other words, they are bought and sold during their lifetime. This activity occurs in what is known as the secondary market. A bond's interest payment, or more accurately its coupon, never changes, even though interest rates in the market change over time. If 1 year later interest rates have moved higher and new bonds are paying 6%, no buyer would be willing to buy a $1,000 bond when it's only paying 4.38% currently. If an investor chooses to sell this bond at this time, the holder will have to accept less. This is called a discount to his original price. For example, if after 1 year an investor sold his bond for $950, the total return would have been the $950 plus the $43.80 in interest. As this is less than the original $1,000, he would incur a small loss of $6.20. However, if a year later interest rates have now declined to perhaps 4%, an investor will be able to sell his bond for more than he paid. We call this selling at a premium. In this example, the holder may be able to sell his bond for $1,050 plus the interest of $43.80, giving him a total return of a little less than $1,100. His total profit would be $93.80. To calculate the yield to the new investor, we need to divide the coupon rate by the price he paid. In this case, the coupon is $43.80, but the new investor bought the bond for $1,050. If we divide $43.80 by 1,050, we get a rate of return of 4.17%, but that isn't really sufficiently accurate. There's a more accurate way to calculate a bond's yield. It's called the yield to maturity. This takes into account the years remaining until the bond matures, because we're buying the bond for $1,050 and it will mature at $1,000. In our Sun Life example, the $50 loss is amortized over the remaining 9 years of the bond, or $4.50 a year in capital loss. And thus, when you look at the formula, the more accurate yield to maturity is about 3.83%. In the secondary market, bonds will show two different prices. For example, a bond may show a price of $98.50 bid to $98.75 on the offer. This indicates the lowest price that somebody is willing to sell, $98.75, and the highest price that someone's willing to buy, $98.50. Although bonds generally trade in $1,000 denominations, they are priced as if they traded in $100 denominations. So the reality, this means that someone would be willing to buy this bond for $985, yet the lowest anyone is willing to sell it is $987.50. This difference in price is known as the spread. But don't forget, folks, bonds are issued at $100 and mature at $100. And generally speaking, we buy bonds with the expectation of holding them to maturity. Short-term changes in price doesn't change our strategy. That wraps it up for this segment. Please come back and watch some other segments. I'm Sean Rickerby of Rickerby Wealth Group at TD Waterhouse. For more information, you can call me at 604-482-5188 or email me at sean.rickerby@td.com.